We got earnings from two prominent U.S. companies today as earnings season heats up. Procter Gamble posted mixed results and cut its annual earnings forecast. And aircraft engine giant GE Aerospace came in with better than expected profits, thanks to rising demand for air travel. Let's get more from Justin Elliott, portfolio manager at Caldwell Investment Management. Justin, thank you very much indeed for joining us. Really appreciate it. Give us your take on the P&G earnings first, if you would.
Yeah, so P&G earnings, bit of a continuation of trends in recent quarters, where a lot of their growth has been driven by pricing, but they're losing share on the volume side. And if you think of P&G and their brands, stuff like Tide Pods, for example, they're typically more premium priced. And we know the dynamics going on in the US right now with the K-shaped economy, particularly pressuring the lower income consumer, means that those consumers are looking for more affordable options and they're what's called trading down or looking for more value-oriented brands. And so that's kind of taken some wind out of P&G's sales. And it's been, a negative aspect to the story regarding their organic growth going forward. So we don't really think that's going to change. We think, that lower end consumer will still sort of remain pressured in the near to medium term. And so they're going to struggle with their organic growth outlook. There were a few kind of bright spots, China returning to growth. That had been a challenge market as well. But we think overall, it's the beat was sort of driven by, and the outlook and guidance increase was driven by, for example, taking your tariff impact down or better results from foreign exchange, for example. We don't necessarily view that as a super high quality beat. We'd like to see that organic growth profile sort of pick up. And so for us, this was, not an outstanding quarter in any way. I think it kind of met a lot of investors' expectations. Mm-hmm. And so we're kind of seeing that in the stock price today. If you look at the valuation of the stock, it is sort of the cheapest it's been really in the last 5 years. That kind of reflects a lot of the dynamics that we talked about. But again, to kind of get a re-rating in the stock going forward, we think you need to see a pickup in that top line growth, which, we think is going to be challenging.
Broader, is this a stock that you would consider just buying and forgetting about? It was a classic blue chip holding for years in the United States.
Yeah, we still think there's a lot of brand value for their entire portfolio. Again, I think there's just better growth opportunities in the market. So if you perhaps have a 5-year outlook and P&G is able to sort of overcome some of these tariff headwinds, and bring that organic growth outlook up, I think the stock could re-rate over time. But in sort of the more near term, medium term, we just think those challenges for growth are going to be an impediment for the stock re-rating. So I guess we would call it a hold right now, unless you had a much sort of longer term outlook on the stock.
GE Aerospace, a very different company, and of course in a near oligopoly globally on aircraft engines. Is this a stock that you would be tempted to hold for the long term?
Yeah, so GE, their earnings had a couple nitpicks as well. I think one of the biggest issues that investors had were basically flat margin outlook for their engine division. And the dynamics there are that because of the supply chain issues that are impacting Boeing and Airbus, and that's impacting their ability to ramp production rates, that sort of trickles down the supply chain to suppliers like GE. They supply basically the major, the entire engine really for the Boeing 737, the 777, which is, their wide body aircraft. Mm-hmm. So when these new aircraft generations are introduced, the engines are often sold at a loss with the hopes of gaining the longer term services contract, right? The maintenance of that engine over time, which is where the margin comes from. As you push out the basically deliveries of those new engines, you don't get that service revenue coming in as quick as expected. And so that's sort of pressuring the margin outlook there. Just the losses as well to kind of really ramp up production and get it to the volumes that they expect. Now, that being said, we do see a very long pipeline in terms of new production coming from Boeing and Airbus over the next really 5 to 10 years even. they both got sort of 10-year backlogs to deliver new planes. And so we do see this as a very attractive market going forward. In the meantime, until they hit production, airlines are keeping older planes in production longer, and that's driving up service revenue, which I spoke to as sort of higher margins. So you've got a lot of offsets in the sort of near term, and then you've got a great long-term growth outlook. The sell-off today, I think, is really just more valuation driven for GE. But the whole aerospace kind of aftermarket supply chain and OE supply chain is trading fairly expensive, given that nice long-term dynamic. So, we would be a long-term holder of this stock. We like other stocks in that space a little bit better, which we hold in some of our funds. But we view the space as attractive overall.
You have a couple of stock ideas for us. Interactive Brokers. Just to remind us what they do, please, and what draws you to that name.
Yeah, indeed. So Interactive Brokers is a basically fully automated brokerage platform catering to retail and sort of more sophisticated investors. They actually just had their earnings yesterday, and they're really showing incredible growth in their user base, and it's driven by the tech-driven nature of the firm and what are called APIs. So they've been able to go into international markets and let financial firms in those markets basically plug and play into Interactive Brokers platforms. And that allows Interactive Brokers to get a much broader investor base sort of trading off of their infrastructure. And so, they've been growing these accounts at sort of 30% year over year for the last couple of quarters. They see that continuing going forward, but there's still very low penetration relative to the kind of amount of global sophisticated traders versus what they have on the platform today. It's something like 4 million on the platform today to maybe 60 to 80 million globally. So we still see a really long growth runway for them to go out there and capture that market share.
And just finally, another aerospace name, Howmet Aerospace, HWM in New York. Give us a brief rundown on why you like that company, please.
Yes. So Howmet is one of the suppliers that I talked about, sort of, down the supply chain. They supply a lot of the components that are in the actual aircraft engines. They're in the fuselage of the plane, sort of putting the whole body together. And they've seen really robust demand for their spare parts business. And that goes back to what I spoke about with airlines extending the lives of their current fleet because they're not able to basically swap out for new planes given the delays in productions. And so that's really driven a lot of growth in their spare parts business. We see that as durable, really, again, until that production rate kind of sustainably increases and a lot of the supply chain kinks are ironed out. They also have a very strong and growing business that's tied to sort of the power generation, which goes back to AI and the data center build out. So they supply the turbine blades that are used in gas turbines to power a lot of these data centers, as they look for alternate sources of energy, given how long it takes to connect to the main utility grid. And so very strong demand growth there. We think, again, that's very robust. You've got visibility there for the next sort of 5+ years. And we think, we like that outlook for that stock.
Thank you very much. As ever, it's great hearing from you, Justin.
Thanks for having me on.
Justin Elliott, Portfolio Manager at Caldwell Investment Management.